Hi guys, Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical precious metals brokerage house. So today I'm going to start talking about inflation because I don't think people really understand it. But as Milton Friedman said, inflation is one form of taxation that can be imposed without legislation. Eric, do you want to? Thank you. And this is baked into fiat money. So by design, over time, it is designed to get you to work for less because of that nominal confusion that we've talked about in the past. So I want you to understand that this is not possible on a gold standard, and I'm going to show you that. But I'm also going to explain the bonds. Now this top chart, here, Eric, can you take that? Okay. This top chart is the CPI, or Consumer Price Index, which is how the government gauges the rate of inflation. They've been shooting for 2%. Now, you can look at your personal experience and know whether or not that's accurate, but just staying with what they're talking about, they said that this most current count, actually they're at 2.5% inflation year over year. Now, here's the problem. This bottom chart, can you see that?
Yeah.
Okay, reflects your purchasing power. So that's how inflation impacts the dollar. Okay.
So meaning inflation goes up and the value of the dollar goes down.
Correct.
Yep.
Okay, so unless what you have your dollars in keeps pace with the true rate of inflation, regardless of what they make it look like, that nominal confusion piece, your value is still going down. All right. Now, I want to explain that's simply put inflation. I'm going to talk about it next week in relation to stocks. This week, I really want to talk about bonds. So I want to show you a bond, a bill, a note, any one of them are all debt instruments. So if you were to buy a government bond or a corporate bond, then what you're actually doing is loaning that entity money. And whatever rate you agree to when you buy the bond, you lock it in. So let me show you how bonds work, because this is important. Okay, this is the date of issue, right in the middle, all right? This is interest rates, this is principal, okay? When interest rates go down, the principal bond of the principal of the bond, the current bonds that are out there, go up.
Meaning the price.
The price. When interest rates go up, the principal value or the price of the bond goes down, because bonds must always be at market, whatever the current market is. So if you, for example, when a bond is issued, it's issued at par, so say $1,000. And let's say there's a coupon, just to make life easy, of 2%. So if interest rates go to 2.5%, okay, you can see how the principal or the price of the bond goes down, but you can also see that the longer the maturity, the greater the fluctuation. Okay, can you see that? So shorter term bonds that are maturing, say in a year, are going to have less fluctuation than, say, bonds that mature in 30 years. It really is just that simple, except for derivatives, and we're going to talk about that. So I want you to understand, before I move forward with this, that bonds, bills, notes are always debt instruments, and they must always be priced at market. So for you as a holder of a bond, that matters. And we know that interest rates have been below 2%, below even 0% in many cases. So in that case, we absolutely know without a doubt that they are not keeping pace with inflation. And that too is all by design. So this is the 10-year Treasury, and you can see what I'm talking about. This is the price, and this is the yield. Can they see that okay, guys?
Yeah.
Okay? So you see how they're a mirror image, just what I was trying to show you. Now, we do know that central banks have been dumping Treasury bonds. And you can see that particularly once we hit 2012, that's the shift in the U.S. Treasury has been more toward the selling of it, and that's been escalating. Now this is showing you how all of the central banks, can you see all of that, or do you want to take it?
No,
yes?
Look, yeah,
okay.
You can see it.
Because really all this is about is showing you the correlation and how similar all of these government bonds are, whether it's the Treasury or the Japanese government bond or the German government bond. But you can also see how interest rates have been moving up. So you could see that correlation. Now, why does all of this really matter? Okay, I'm getting there, Carl. I'm sorry, this is going to be a little long, but this is an important one. These are from the ISDA, so it's those guys that regulate the derivatives. And these are the current, I pulled this morning, the current interest rate derivatives that are out there. And you should be able to see that it's something like notional, which means we don't know what the value is at risk, but a notional value of over 533 trillion in those bets that are written against these interest rates. So when you see these interest rates, oops, am I on the other way?
Flip it over.
Oops, thank you. Spiking, okay, that's going to impact these derivative trades, okay? And we've talked a lot about them. But this is the income that the banks generate, excuse me, from those interest rate derivatives, which is 20% or more of their revenue. So they're not really going to stop those. What we do not know is what interest rate level will trigger a negative derivative event. So for you as an individual, if you hold bonds in a rising interest rate environment, if you have any bond ETFs, bond mutual funds, any of that kind of stuff, in this rising interest rate environment, that's what's happening to your principal. All right? And it does not look like that's going to change because all of the economic policies of the Trump administration are for inflation, and that's also what the government wants. Because remember, inflation is an invisible tax on your wealth and the amount that you work for. So it matters. But why don't they like gold? So that's it for bonds. Well, here, this line up here shows you this whole thing is currencies in terms of gold. Gold eliminates the government's ability to generate that inflation or the central banker's inflation. So this top line here is gold, and all these other currencies, you can see how their purchasing power, how inflation has impacted the purchasing power of all of those currencies. The intention is to inflate this debt away. The debt is not payable. That's what that reset is about. So that's why we've seen central bankers buying gold. And that's why people that understand money own gold. It's very, very simple. So next week, I'm going to show you how that inflation correlates or why the stock market goes up during inflation. Because that's what they want. It's a perception thing. But we'll talk about that next week. So have a great weekend. Be safe out there. Remember to like us on Facebook, subscribe to us on YouTube, follow us on Twitter, and give us a call at 888-696-4653. Have a safe weekend. Bye-bye.